Hey, how are you? I'm Duncan McPherson and welcome back to my channel. Today is the third in my four-part video series where I'll be discussing with you the CRA penalties that are either not so obvious or not so easily avoided. So listen up because it is very easy for you to unwittingly get caught with interest or a penalty up here. And as always, before we get rolling, don't forget to hit that subscribe button and the notification bell for more tips on how you can better survive and thrive in the Canadian tax system as a U.S. business or individual. Or if you'd rather cut through all the nonsense and get help right now, contact me at themactax.com and let's get chatting. So in today's video, I'm going to talk to you about a few more hidden penalty tools that CRA has in their arsenal that you could encounter once you're carrying on business up here. This stuff is pretty high end, so you may or may not be familiar with it. So listen up and take notes if you have to. But to give you a heads up before I begin, a lot of this video will deal with some of the uncommon penalties that you may have to deal with. But common or uncommon, like I always tell you, with a little bit of planning and keeping your books and records up to date, you can easily dodge these uncommon penalties as well. So first on our list is the GST, our national sales tax. Incidentally, today is April 3rd, the day after your U.S. Liberation Day. Today, your White House plans to put counter tariffs on the European VAT, even though the VAT is not a tariff. Note that our GST in Canada works exactly the same as the European VAT. So please don't tell the White House or we'll see more tariffs up here in Canada. Okay, so let's move on to what happens if your GST is filed late. You may be filing GST monthly, quarterly, or annually. Well, the GST return is due 1 month after the end of your filing period. And there is an initial penalty of 1% per month plus interest for a late filed return. With GST, you need to perform a lot of detailed bookkeeping in order to get it done. If you can't get your bookkeeping done on time, you can estimate the tax, pay it, and file late. You can always overpay the GST before it is due to give yourself more time to file accurately, and then ask for a refund when you file the return. I'll tell you right now, CRA actually refunds this pretty quickly up here. Also, if you're out a little in one period, you can true it up in the next period. CRA is okay with this. And believe it or not, CRA will never penalize you for doing this unless the timing difference is extreme and in their favor, of course. But whatever you do, file on time or pay early or be prepared to deal with all the penalties and the CRA letters. And I'm telling you right now, the hassles are worse than the penalties. Also note, the GST are trust funds and CRA does have the right to go after your corporate directors for the GST if it remains unpaid. Gross, right? Another peculiar thing about the GST is because they are trust funds, and because you are a non-resident, you are required to post security with CRA equal to 50% of the amount of the GST that you collected in the previous year. As I've mentioned in previous videos, for whatever reason, CRA may not ask you for this security until you've actually been collecting the HST for a number of years. We have absolutely no idea why they don't ask you for it when you register, because you have to register for GST as a non-resident. I don't get it. Nobody gets it, but that's where we're at. But when CRA finally does notice it, they will assess you for the security the same way they would assess you for the HST. You'll actually get a bill, and this amount can actually be in the tens or even hundreds of thousands of dollars. But don't worry, because there is a workaround. You can provide CRA with a surety bond in lieu of the cash amount of the bond. I have gone over this in 2 previous videos on how you do this. And make sure you check it out here because I have no time to go over it in today's video. I'm sorry. Next on my list for you is the General Anti-Avoidance Rule. They don't really have an equivalent to this in the United States. The General Anti-Avoidance Rule is more affectionately referred to as GAR, G-A-A-R. But be aware, because the GAR rules are very broadly worded and highly technical. I'll try to be as succinct as possible, but bear with me as I read this off my cheat sheet. GAR gives CRA the power to reassess a transaction or a set of transactions that has no other purpose than to avoid tax, where the transaction or set of transactions is out of the object, spirit, or purpose of the sections of the Act the taxpayer relied on to avoid the tax. Note the courts have set the bar very high for CRA to use GAR against you. And while it's important to make you aware of GAR, it is not something that you could unwittingly walk into in the normal course of operating your business up here in Canada. Just know that it's there if you start working on some very in-depth tax planning. That's all I have to say on GAR today. You can contact me at themactax.com if you need to know more. Okay, so let's start talking about a few more tangible things that you're likely to run into as a non-resident operating your business up here in Canada. In a previous video, I went into detail on the thin capitalization rules up here in Canada. They're the same as in the United States, where in Canada you're permitted to have $1.5 of debt for every dollar of equity. But just note that any interest you pay back to the United States beyond this ratio will be denied as an expense here in Canada, which again is actually the same rule you have in the United States. But up here in Canada, CRA can recharacterize your overpaid interest as a dividend. And presto changeo, that makes you subject to dividend withholding tax up here. Now, generally, your withholding tax will be 5% if your Canadian shares are owned by your US corporation. But as you'll be paying this withholding tax late, you will be required to pay interest on the late withholding as well. Note, under the Canada-US tax treaty, you do not remit withholding tax on interest that you pay between one country and the other. Okay, now just to recap everything that we went over today, here are the stealthier penalties for you to avoid. Number one, 1% per month on your late filed GST returns. Number two, penalties assessed against you from violating GAR. Penalties plus interest assessed against you for violating our thin cap rules. And number four, also dividend withholding tax from your recharacterized interest from violating the thin cap rules. All right, my friend, that's it for today. Now you have a list of penalties to watch out for as you expand into Canada. But as always, remember, many of your tax problems can be avoided with a little quality planning and quality bookkeeping. But let's be realistic. If you watch this far, you're probably concerned about penalties, right? So if this is you, don't forget you can always contact me at themactax.com and I'll get you through this maze of bureaucracy. And of course, as always, don't forget to subscribe for more tax savings tips. Until next time, stay sharp, stay compliant, and stay out of tax trouble. And I'll see you on the next video.